Good morning, Black America. Grand Rising, beloved. I'm Crypto Stock Markets, and here's what's moving the market today. Today, we're not talking about charts. We're not talking about price action. We're talking about structure. The Federal Reserve have moved to permanently remove what's called reputational risk from how it supervises banks. Now, let's break that down. For years, when regulators examined banks, they didn't just look at capital ratios. They didn't just look at liquidity levels. They didn't just look at compliance systems. They also evaluated something called reputational risk, meaning if a bank worked with a client or an industry regulators believe could create controversy, backlash, or political heat, that bank could be questioned. Not because the numbers were weak, not because the activity was illegal, but because it might look risky. And when regulators signal that something looks risky, banks respond. They de-risk, they close accounts, they limit exposure. That is how debanking often happens, and quietly. Now, recently, this issue resurfaced in political conversations. There were discussions around banks cutting ties with high-profile political figures. Names like Trump came up. References tied to Epstein relationships were discussed in broader debates about who banks choose to serve. And once powerful individuals feel the pressure of subjective standards, suddenly there's urgency to clarify the language. Suddenly we need definitions tightened. Suddenly we need codification. Family. This practice did not begin yesterday. Subjective risk labeling has existed for decades. Redlining was framed as risk management. Entire neighborhoods labeled unstable. Black communities marked as risky. Black businesses treated as fragile. Loans denied. Credit restricted. Growth slowed. And often it was not about measurable numbers, it was about perception. Perception dressed up as prudence. Now the Federal Reserve is saying supervision must focus strictly on measurable financial risks, capital, liquidity, compliance. Not perception, not optics, not controversy. That matters. Because when standards are measurable, discretion shrinks. And when discretion shrinks, bias has less room to hide. Now, let me say something clearly. Banks are private institutions. They can choose to do business with whomever they want. That is why group economics matters. That is why ownership matters. That is why building and banking with each other matters. And that is why digital vehicles like FBA coin matter. Code does not see color. Smart contracts do not see perception. The rules execute based on math, not mood. So while banks may always retain discretion, decentralized systems reduce human subjectivity. That is structural power. Now let's be clear. This regulatory change does not force banks to serve everyone. It does not remove compliance standards. It does not legalize wrongdoing. It simply removes a vague supervisory lever. And that lever has historically shaped access. It is 2026 and we are still codifying language to prevent subjective exclusion. That should tell you something. Sometimes reform happens because marginalized voices push. Sometimes reform happens because powerful people feel the pressure. But the reason is less important than the result. When supervision tightens around measurable standards, opportunity expands. Access to banking is access to commerce. Access to payment rails is access to scale. Access to credit is access to growth. This is not red versus blue. This is structure versus subjectivity. And when subjectivity shrinks, the field becomes more level. Pay attention to where discretion lives. Pay attention to who defines risk. Pay attention when language changes, because language and regulation determines access in real life. I'm Crypto Stock Markets, and that's what's moving the market today.